Hello everyone, welcome to Demand Supply Trading Practical Session number 40 for the year 2025. Myself Srajit Kakar, and today is Sunday 19th of October 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk controlled in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. Plus, we also update you regarding the schedule of these live sessions. And in case we have any promotions or any discounts coming up, we also update you on that channel. So in case you've still not joined this channel and you wish to join it, there are a few different ways you can do it. The first one is you can scan the QR code which is on your screen. Second, if you go to the description of this video, you'll be able to find the direct link using which you can join the channel. And thirdly, when you visit our website, which is surjitkakar.com, or you can use the short URL that is sk.coach. So once you're on our website, you can just scroll down on any of the pages. I'll just quickly show you. So once you're on our website, just scroll down on any of the pages to the footer section. And in the footer section, you'll be able to see this banner which says join the Telegram channel. Here you have the join now button. You can click on this button and you can join the Telegram channel. All right. So today's session is all about practical application of demand supply trading methodology. So our demand supply course is now available as a 100% free course. And once you go through the course, you learn the methodology theoretically. Now, how do you access the course? We'll talk about it as we move forward in the session. But whatever you're learning in the course theoretically, unless and until you see some practical examples, at times it's not very easy to understand how to implement it. And that is what we do in these live sessions, that every weekend I do a live session where we take some real life examples, and to those examples we apply the complete methodology so that you can learn how to plan trades using demand and supply. Now the other beauty of this session is, in fact, two things I'll talk about. One, since it is a live session, so if you have any queries related to demand supply trading, or even related to trading in general, you can always put your queries in the chat box, and at the end of the session I'll take your queries and I'll answer them. So in a way, it's a live environment where you can interact with me, you can share your feedback, you can share your queries, and I'll help you with them. Second, when we talk about these practical sessions, the best part about these practical sessions is that we are not looking into something which has already happened, because like I always say, that a move which has already happened, it's very easy to justify it using a number of indicators, oscillators, maybe even price action. But in demand supply methodology, what we do is we pre-plan the areas where we would like to be buyers and sellers. So we are always pre-planning the trade. So we are doing the analysis in advance, and nobody knows what is going to be the outcome in the future. So we are always planning in advance. And like I always say, that nothing can be more transparent than planning the trades well in advance. And eventually when the prices, they revisit those areas of demand and supply, we also review them. So you get to see both the before as well as the after. And that helps you build confidence in the methodology. Now, to be comfortable with these sessions, there are few prerequisites. And completing these prerequisites will make these sessions much more easier for you. So let's talk about what these prerequisites are. So the first one is the Trading Essentials course, optional for people who already have a very good trading background, a very good understanding of trading terminology. If those people, they want to skip it, yes, they can. However, my recommendation would be that irrespective of what your trading background is, do start with the Trading Essentials course. Now, how do you access the Trading Essentials course? Very simple. Once you're on our website, under services, you can see you have this option which says courses. Click on it. And the very first one you can see is Trading Essentials. Click on Trading Essentials. The course is available in 2 languages, English and Hindi. So whatever language you're comfortable with, click on that button and you'll get immediate access to the course content. No signups, no registration required. It's in a form of a playlist. So go through all the lessons one by one. And once you have completed all the lessons, that basically covers your Trading Essentials course. Now, after you are done with the Trading Essentials course, the next step is your Demand Supply Trading course. Now, how do you access the Demand Supply Trading course? Exactly the same steps. Under services, go to courses, and now you can see the next one is the Demand Supply Trading. Now, this is also available in 2 languages, English and Hindi. So whatever language you're comfortable with, you can click on that button. You'll get immediate access, no signups, no registration required. And again, it is laid out for you in a very systematic way. You have lesson 1, lesson 2, lesson 3. So just complete all the lessons. And once you're done with all the lessons, that basically covers your trading, your demand supply trading course. Now, when you go through this course, like I said, you will be learning the methodology theoretically. So along with theory, we also need to see the practical application of it. So what I do is, like I already said, every weekend I do a practical session where we get into the practical application of demand supply methodology. But these sessions are also recorded. So in case you miss the session, or you want to rewatch the session, or you want to watch multiple number of sessions, you can always click on the practical session button. And these sessions are also available in 2 languages, English and Hindi. So we record all these sessions for you, and currently we have an archive which is getting closer to 2 years of recording. So you have a lot of content available to you. The more number of practical sessions you will see, the better you'll start having the understanding of how to apply the demand supply trading methodology. So yes, the resources are available. Go through as many sessions as you can, and eventually you will be trading demand supply, and it's not a very complicated methodology. It's a very simple methodology. It's just that anytime you're learning something new, yes, initially it might feel a little overwhelming, and that is the reason we have all these resources available to you, so that you can go through as many sessions as possible and quickly reach a point where things are much more easier on you. All right, so before we get started with our analysis for today, we do have some examples which are getting carried forward. In fact, even before we talk about the examples, we forgot 2 more prerequisites. The other 2 are the rulebook and the flowchart. Now, during the live session, you will see that I use these 2 documents to plan trades very mechanically and rule-based. So how do you access these 2 documents? Very simple. On our website, under services, go to the download section. And in downloads, you can see you have your rule book and you have the flowchart. So this is your rule book. And this is your flowchart. Now, how do we use these documents? You will experience this during the live session. So as we start with the analysis, I'll be using these documents step by step, and you'll be able to understand how to use them. All right, now coming back to I said we have few trades which got triggered and few trades which were getting carried forward. So let's start with the review of them. And once we are done with the review, then we'll start with our today's analysis. So the very first one is from session number 32, which was getting carried forward for us for a pretty long time. But now you can see prices have gone below the zone. So we'll mark it as a stopped out trade, right? So we'll be closing it, and that takes care of this. In fact, we did talk about that on the lower time frame RR was not nice, but yes, this could have been held for the target which we had on the intermediate time frame. Prices came definitely pretty close to our 1:1, but we didn't get the opportunity to make it as a break-even trade. So this will be closed as a stopped out trade. So we'll not be carrying forward it any further now, and this will be closed. So that's the first one which was getting carried forward. Now let me bring up the next one, which was again getting carried forward from the previous session. Just give me a minute. Let me find it for you. There it is. So this is from session number 37, and we talked about it that this can be a type 1 trade for us. We definitely got the entry on it. We are still waiting for the target. So no modification to this one. This will still remain as an open trade, and we'll keep tracking it unless and until we get an exit on it. So the analysis was done on the 28th of September. Prices came into the zone on the 8th of October. This was a type 1 trade for us, session number 37. And the last one which got triggered this week, right? So let's bring that up as well. I mean, even though it got triggered, but this would not be a trade where we would have been able to participate. And the reason for that is, just give me a second. So this is from session number 38. We did the session on the 5th of October. Prices came into the zone on the 17th of October. So 5th of October is somewhere around here, right? So when we did the analysis, the chart would be something like this. And you can see eventually prices came into the zone, just touched the zone. As of now, we are getting a reaction from it. But the challenge was that this was a type 2, type 3 trade for us. And for type 2, type 3 trades, we wait for the prices to go inside of the zone. And then we have to wait for a bullish or a very bullish candle to form, which did not happen in this case. So going with the rules of a type 2, type 3 trade, we would have not been able to participate. But yes, as of now, prices have just touched the zone on Friday. We are getting a small little reaction, but we'll mark it as no trade. Reason being, it was a type 2 or a type 3 trade where you would have not got the opportunity, and now the zone is already tested. So I ideally don't like to trade tested zones. But yes, if you are someone who is okay with trading tested zones, and if the prices again come back into the zone, you get a bullish or a very bullish candle inside of the zone, you want to trade it, that's your choice, that's your personal trade plan. But based on my trade plan, if it is a type 2 type 3 trade and the zone has been tested, this is no longer a valid trade for me now. All right, so that takes care of some of the trades which were getting carried forward and some of the trades which got triggered during the week. And now that we are done with the review, let's get started with our analysis for today. So just give me a minute. Let me bring it up. It's gonna take me a few seconds. Okay, give me a second. Alright, so I'll have to bear with me for a few seconds because I did not add the one to the list, the one we wanted to analyze today. I'm just trying to find it quickly for you. So you'll have to bear with me for a few seconds. So what happened was I did shortlist it, but I did not add it to the watch list. So now I'm trying to identify. Okay, I found it. God. Right, so just give me a second. Almost done. Generally doesn't happen, right? Generally I always have it in my watch list so that I can quickly pick it, but somehow it skipped my mind today to add it to the watch list. But not a problem. I am done with this, and now we have the uh, setup ready for us. Perfect. So let's get started with our analysis for today. So first and foremost, whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video, and the title of that video is How to Start Trading. You can find the link in the description, and make sure you watch that video. Very, very important video. And the process I've explained in that video, everyone will have to go through that process, maybe once, maybe twice, maybe thrice. But once you have gone through that process multiple number of times, by default, you will start seeing that your trades will be more rule-based and less emotion-based, which is very, very important. So again, do watch that video. But since we need to be mechanical and rule-based, what we need to do is we need to create something which is called as a trade plan. Now, it's not very easy to create a trade plan from day one when you start trading or when you start learning a new methodology. So to overcome this challenge, what I've done is I have created this ready-made trade plan for you, which is a combination of two documents, your trade plan steps, which is basically the walkthrough or the flow chart, which guides us what we need to do as a demand and supply trader step by step. And the second one is the rule book. Now, this rule book that I've shared with you is a conservative approach, because when we start learning trading, it definitely makes sense to start with a conservative approach. But as you start having more and more experience, you start building up your confidence. If you want to make some modifications based on your personality style, you can definitely make those modifications. But at least you do have a starting point using which you can start planning your trades. So what is my step number one whenever we start planning trades? Step number one is I need to define my trade purpose. So what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So the question comes, why do we start with the trade purpose as our very first step? And the answer to that question is that when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach, and that logical approach is that the longer I want the duration of the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. If you are trading markets which are not 24-hour markets, example, if I take the NSE India market, which is not a 24-hour market, so I'm pretty sure you people would have experienced whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market which is not a 24-hour market, we do have that added gap risk, which initially we would like to avoid. And that is why my recommendation to all of you is that initially your hourlies and dailies will be strictly intraday trades. Which means before the market closes, irrespective whether you're in profit, loss, or break even, you will be closing those positions. You'll not be keeping them overnight and taking that unnecessary overnight gap risk. Now, when it comes to weekly monthlies, anyhow, we are not anticipating to get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But since you are leaning against some bigger time frames, the probability of a gap against you definitely reduces, but it can still happen, right? You still have that probability, but now a little lower. But yes, it can still happen. Again, here you have no choice. You'll have to keep these positions as overnight positions. But as you start having more and more experience, you start building up confidence in your analysis. If you want to include daily incomes into overnight, that can be done, but initially do avoid it. Don't take that unnecessary overnight gap risk. So again, step one was I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I've selected my purpose of trade, what is going to happen from the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 in the rule book, we start with the topic multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my these 4 different time frames? And you get the answer from this table. Now, mind it, this table, which is on page number 31, is specifically for the NSE market, because this market is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, cryptos, some international markets, then you can look into the table which is on page number 32. But since I'll be taking examples from the NSE, I'll be referring to this table. And since I opted, I want to plan monthly income trades. So from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SETS from. SETS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then my refining time frame will be the 60 minutes chart. So now I know my time frames. So my step number one is complete. I have the clarity to what time frames I'll be using. Plus, I also know what is going to be the purpose of each and every time frame. So in this case, we have monthly, weekly, daily, and 60. So challenge number one taken care. Now the next challenge is, yes, I do know my time frames, but if I take example of NSE, on NSE we have over 2000 companies listed. So humanly not possible that every day I sit and analyze 2000 companies. So what we need to do now is we need to have a process in place which can help me get a smaller list out of this bigger list. Because if we have a small list of symbols, we can do our analysis almost every other day to identify where are the opportunities that match with my trade plan. So how do you get this small list? For this, we use certain computer programs which are called as scanners or screeners. So if you'll do a Google search, you'll be able to find n number of free scanners, free screeners, which are based on conventional technical analysis or fundamental analysis, and that can help you shortlist some symbols. But the challenge is that all those scanner screeners are not based on demand supply. And if you don't have a scanner screener which is based on demand supply, it you might have to go through a very big list of symbols before you're able to identify something which is in sync with your trade plan. So to overcome this challenge, what I've also done is I have created two custom built tools which are called as the demand supply zone alerts and the demand supply zone screener, which help us shortlist symbols purely based on demand supply zones. Now both of them function differently, so I'll briefly help you understand what these tools are and how they work. But if you want to understand more in depth about how these tools they basically work, you can always visit our website. And once you visit our website, under services, you can go to trading view indicators, and here you can see you have the alerts and the screener. So simply click on subscribe now button. It will take you to the product page where the walkthrough videos are available. You can go through those walkthrough videos to understand these tools more in depth. But briefly, I'll give you an introduction to these tools. So talking about alerts, so what alerts basically do is, as of now, the only market which is live is the crypto market. So I'm showing you examples from crypto. So what I've done is, can you see here, I've applied the alerts and I'm on the 5 minutes chart. And what I've done is I've given it a list of about 20 symbols. So what will happen now is that during the live market, right, because this market is live as of now, as and when we will have a formation of a demand area or a supply area, it will keep updating us. Now, those of you who have a free trading view account, what will happen for you is, can you see, like here you can see on the chart, it keeps getting updated uh, based on the time frame you're on. So if I'm on a 5 minutes chart, this will keep updating every 5 minutes. If I'm on a 15 minutes chart, it will update every 15 minutes. So it will keep telling me where we have our areas of demand and supply. So again, on a free account, you will see it on the chart. And if you have a paid account, you can also place your alerts, in which case you will also get these notifications, something like this, where these zones are getting formed. So the notifications will be based on your notification setting on TradingView, whether you just want the pop-up, whether you want it via email, whether you want it on the app. So however you set your notifications, you'll also get those notifications. So again, during the live session, as of now, if we get some alerts, I'll show you examples so that you can have an idea about what alerts are. So that is alerts. Now talking about screener. So what screener basically does is, let me disable alerts and enable screener. So what screener basically does is, again, in screener as well, you can input your list of symbols and then you can give your proximity setting. So here you can see I've given my proximity setting as 2%. So what I'm telling the indicator, okay, these are the symbols I want you to look into. And out of these symbols, on whichever symbol I am within 2% to a demand area or a supply area, shortlist for me. So what is happening now? So say again, for the screener, it is not required that the market has to be live. Even if the markets are closed, it will shortlist for you, but alerts are only generated when these zones are getting formed, right? So for the alerts, the market has to be live. For the screener, the market doesn't have to be live. So just as an example, if I go to SBIN, so can you see it shortlisted SBIN, and it is telling me that we have proximity to demand zone. So here you can see we have a demand zone. And if I look from this closing price, you will see that we will be within 2%. You can see we are at 1.95. So that's why it got shortlisted for us. Similarly, if I go to, let's say, TCS, on TCS as well, we'll be having the proximity to the demand area, which you can see here again. And once you have created this list, it is as simple as you just change the time frame. So if I go to weekly, Now you can see I have my results based on the weekly. So if I go to weekly, you will see you will have your proximity to the supply zone. So we are already on TCS, and let's go to the weekly. So can you see I'm on the weekly now, and on the weekly we have proximity to the supply zone. And if I go to the daily, on the daily we had, sorry, let's go back to the weekly. You can see in the weekly we have this proximity to the supply zone, and it should be within 2% to this supply. So you can see it's 1.99. So that is how the screener basically works. It helps you identify symbols where you are within that proximity range to a demand area or a supply area. So let's disable the screener now. And again, if during the session we get some notifications for alerts, I'll show you example of how alerts they basically work. So that's your alerts and screener. Perfect. So now that we are having a brief understanding how they work, let's move ahead. So what you can do is, again, a second step was to get a smaller list of symbols. How you want to get that small list of symbols, that's completely your choice. You want to use those free scanners, screeners, which are available on a number of websites. You can use them. You want to do it purely based on demand supply zones. You have the option for alerts. You have the option for screener. Process can be as simple as I want to have a small list. Maybe I will only be looking at the Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze. So choice is yours how you want to get that small list. But always remember, irrespective how you are shortlisting these symbols, whatever gets shortlisted for you, you can never blindly buy or sell these symbols. So the scanner screeners, they do not tell you what you need to buy or sell. They only help you get a smaller list. And once you have that small list, you'll have to go through them one by one and see which one matches with your trade plan. The one which is in sync with your trade plan might be an opportunity for you. The one which doesn't match with your trade plan, you simply skip it. So let's assume we got a list, and in that list, the very first one was ABC. So what are we supposed to do now? On ABC, we need to go to the lower time frame. So and on the lower time frame, we need to identify zone. And what do we mean by zone? By zone, we mean any of these four structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So the next good news for you people is that even when it comes to identifying areas of demand and supply, we have automated the process. We have an indicator on TradingView which automatically identifies and plots these zones for you. And the best part is you can try it for free for 7 days, right? So if you haven't taken the trial as of now, you can take a free 7 days trial of this indicator and you can experience it. Now, how do you take the trial of the indicator? Very simple. Once you visit our website, go to services, under services, go to TradingView indicators. The fact is, if you're visiting our website for the very first time, you will also be getting a pop-up on the top. But just in case you have closed it and you're no longer getting that pop-up, so under services, go to TradingView indicators. The first one is the demand supply zone indicator. Click on it. And once you're on this page, you will be able to find the 7 days free trial button. Click on the 7 days free trial. And it's a very small form which you need to fill. You just have to provide your full name, your email address, and your TradingView username. Now, in case you don't have an account on TradingView, you can click here. You can create a free TradingView account. And once you have created your TradingView account, you can input your TradingView username here. In case you already have a TradingView account, you can click here. You can visit your profile. And once you're on your profile page, identify your correct TradingView username, input your TradingView username here. And after that, you'll get to know on which date your trial will get expired. How did you hear about us? Choose the correct option. Click on I'm not a robot and click on finish and start your free trial. And once you have filled this form, within 24 hours, it will get activated for you. And once it is activated, you will get a notification on TradingView itself that the indicator has been activated and you can try it for free for 7 days. So since now everyone has that opportunity that you can try the indicator absolutely free for 7 days, whatever analysis we will be doing will be based on the indicator so that you can understand the advantage of the demand supply zone indicator, and you will also see how easy it makes the process for you when you're doing your analysis. So what we need to do now is on the lower time frame, we need to identify the zone. And here you can see, since my indicator is already applied, the indicator is telling us that below the current market price, we have this rally-based rally as a demand area. So the step where I had to identify the zone, now that is no longer required. Now the indicator is doing for us and we have this rally-based rally available to us. So step number 3, identify a zone. Do you have a zone available? The answer is yes, we do have a zone available. And once the zone has been identified, does not mean you will blindly trade it. The next step is to qualify it, which is a two-step process. In step one, we'll qualify based on certain conditions, and in step two, we'll qualify based on the booster scoring. So the first one is, can this zone be a case of level on top of level? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my intermediate time frame zone my lower time frame zone has to be inside the intermediate time frame zone, which we call as a coinciding level. So if you have a coinciding level, there might be a possibility that it might be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And we understand that as a monthly income trader, my intermediate time frame will be weekly. And you can see once I go to the weekly chart, wherever my lower time frame zone is, we don't have any intermediate time frame zone. The intermediate time frame zone is a little lower. So it's not a coinciding level. And since it is not a coinciding level, it cannot be a case of level on top of level. So level on top of level is not applicable. This zone is not because of a gap. Therefore, gap rules will also not apply. Talking about pivot and non-authenticity, we only apply pivot non-authenticity to a drop-based rally or a rally-based drop. So this is also not applicable because currently we have a rally-based rally structure, and unstable equilibrium is also not applicable. So none of these rules are getting applied. And if these rules are not getting applied, they cannot disqualify the zone, right? To disqualify, first they need to be applicable. Then there can be two possibilities, either qualified or disqualified. So since they are not getting applied, by default, the zone is qualified for us. And now the next step will be to qualify based on the booster scoring. So let's start applying the boosters. Let me draw the entry, stop, and back to the entry. So let's start with the boosters. So the very first one is freshness. Definitely the zone is fresh, gets a score of 3. Talking about strength, we have an explosive move. That is the reason the indicator has identified for us, gets a score of 2. Time at the zone, we only have 3 candles, which is again a score of 2, and reward to risk ratio, we'll take it as an assumption. But based on the arrival, things can change, but currently we'll take it as an assumption. So you can see just now I got a notification for the alert. So let me just show you quickly alerts. So can you see we got a notification that on Doge USDT, we have a drop-based rally. So if I go to DOGEUSDT, and you can see as soon as this drop-based rally was formed, we immediately got the notification that we have a drop-based rally structure, and that is what the indicator does. The alerts, they do that as and when during the live market we have formation of demand and supply areas. It keeps updating us, and that's the beauty of the alerts. So let's get back. So yes, we have applied the quality boosters. Let's move on to the next step, which is your location. If I go to the monthly chart, you can see the indicator is automatically doing the curve analysis for me. And based on the curve analysis, we can see that the indicator is overlapping within 2 areas, right? So this is my very low of the curve. This is low of the curve. This is my middle of the curve. This is high of the curve. And this is my very high of the curve. And you can see this zone is overlapping in 2 areas, which is your middle of the curve and the low of the curve. So when a zone overlaps in 2 areas, how do I decide? Should I be calling it as middle of the curve, or should I be calling it as low of the curve? The answer is very, very simple. The location is always defined by at what area am I entering the trade. So this is where I'm not entering the trade. This is where your stop loss will be. You are entering the trade at this area, which is the middle of the curve. So your location is middle of the curve, and middle of the curve gets a score of 0. Talking about the trend, if I go to the intermediate time frame, you can see the indicator automatically does the zone violation analysis for us, and you can see it is telling us we have 2 supply zone violations, and 2 supply zone violations can mean we are in an uptrend, and being in an uptrend will be a score of 0.5. Next move from the zone, we need at least 4:1, which has not yet happened. So currently it is going to be a score of 0. But if the prices, they move up and then they start returning, it might upgrade to a score of 2. As of now, it will be a score of 0. It's not a case of level on top of level, not even coinciding. And talking about trap, let's see, can it work like a trap? I'll take a horizontal line wherever the proximal is. We'll zoom out a little bit and start pushing it up, trying to find an area where the prices have been bouncing over and over again. So if you start with the most recent past, you can see it acted like support, acted like resistance. Here also acting like resistance, but here we have a lot of whipsaws. Here it did act like support, almost acting like support. So we do have an area which in the recent past, maybe I can say has acted like support, has acted like resistance, but we also had a lot of whipsaws here. So ideally, I would love to see an area which is almost like a textbook example, picture perfect support resistance kind of a scenario. But here, because of all these whipsaws that we saw, I would, as of now, would not like to give it a score of 1 for trap. I would give it a score of 0. So if you look at the overall setup, we have a high quality setup, but the probability is low, which makes it as a type 2, type 3 trade for us. So going back, after applying the boosters, we got to know that this can be a type 2 or a type 3 trade. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a position size calculation. Now, whenever the prices are back, we will have to re-verify. Why do we have to re-verify? Because the markets are not static, markets are dynamic, conditions are changing almost every other second. So before entering a trade, we always have to re-verify that does it still qualify based on my trade plan the way we just did. If the answer is yes, you place your order based on the entry type. In this case, it's a type 2 or a type 3 trade. And once your order has been executed, the last step is your trade management, where step 1 is at 1:1, we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule-based. And if these sessions are helping you plan better trades, then do like the video. If you are not subscribed to my channel, do subscribe to it. If you have any feedback, if you have any questions, queries, or comments, you can always put it in the comment section. And last but not the least, I'm pretty sure you people also understand that a lot of people are struggling with trading. And because my course is free, these live sessions are free, the access to the trial is free, a lot of free resources are available. So I would highly appreciate if you can share these links to the course content, to the live sessions, to the trial of the demand and supply zone indicator. If you are on some trading groups, if you are part of some trading group, you can share with your fellow traders. If you have any friends or family members who are into trading, you can also share with them, so that more and more people can take advantage of it. And like already said, since all these resources are free, it doesn't cost them anything, but yes, it might help them a lot when it comes to their personal trades. Now, what I do is at the end of the session, I look into the questions, queries which you people have posted in the chat box. But before I do that, let me also touch upon this, that one feedback which I was getting from you people is that yes, I do take the questions, queries at the end of the session. But what if I don't want to ask my questions publicly, or in the YouTube chat, I can only post my questions, I can't share my analysis? What if I want to share my analysis for review? So we do have an option for it, which is called as one-to-one appointment. So once you're on a website, on the top right corner, you'll be able to find this option which says one-to-one. And there are two kind of appointments available. One is a voice call. So if you feel that on a voice call, you can ask your questions, queries, and you'll be done with it, you can go for a voice call. And if you feel you want to share your analysis, you want to share your screen, then you can also go for an online meeting. So that option is definitely there. But yes, if you are comfortable, you can always put your questions, queries in the chat box. And at the end of the session, I'll try to answer all the questions that we get during the session. So let's see what we have in the chat box today. In 3 back-to-back rally-based rally demand zones form, but not coinciding, then all type 1, then which zone should I need to take the entry? So Naveen, the answer is very simple, the nearest and qualified. So let's assume that you have 1 rally-based rally, you have 2, you have 3, right? And what you're saying is these are not cases of level on top of level, so all of them are standalone levels. So what I'll do is I'll start with the very just give me a second. Right, so what I'll do is I'll start with the very first one. I'll qualify based on my trade plan. If it qualifies based on my trade plan, this is the one I'll be using. If it doesn't qualify, then I'll look at the second one. If this doesn't qualify, then I look at the third one. If none of them they qualify, I don't have an opportunity. If all three of them are qualifying, I might take the first one. If I get stopped out, then maybe I can move on to the next one. So again, the answer is very simple: nearest and qualified. A simple example can be when you're doing the analysis, this might be, let's say, high on the curve, and you might say, okay, I don't use something which is high on the curve. This might also be middle on the curve, right? So things can change. Maybe it is low on the curve, but you want to be in sync with the trend, so which disqualifies this, and maybe this one is very low on the curve where trend is irrelevant. So again, whatever your trade plan is, based on your trade plan, whichever qualifies, that is the one you will be going with. Also, is there any discount on the occasion of Diwali? My yearly subscription is over. See, the fact is, we very rarely provide discounts. The reason is, if you look at the pricing of our tools, they are already as good as free, right? Based on the kind of value we provide, we know that we have made these indicators pricing such that it doesn't in fact, I'll say it doesn't even justify how cheap we are providing these tools. So that is the reason very rarely we provide any discounts. So as of now, we don't have any plans, but yes, you can always join our Telegram channel in case we come up with any promotions. We will update you there, but currently we don't have any promotions. And again, I'll add, when it comes to the 60 days and the annual subscription, we already have a discount applied as well. So if you compare the 60 days subscription by taking the monthly twice, you will have around 16% discount on it, which is already applied. And if you talk about the annual subscription, so compared to taking the monthly subscription for 12 months individually versus going for an annual subscription, it is a discount of almost 30%. So these discounts are already applied, but over and above it, currently we don't have any discount. For intraday, it's best. See, again, the tools that we have, they can be used for any purpose of trading, be that intraday, be that swing, be that long term. But yes, if you were talking about alerts, I will definitely agree with it that alerts is a little bit more inclined to somebody who's into intraday trading, because during the live market, you want to know where these zones are getting formed, so that if you are an active trader, you don't miss on some of these opportunities. But yes, if you talk about screener, that can also help you by shortlisting, because even during the live market, if you're getting closer to some demand areas or supply areas, screener can also help you shortlist those demand supply zones. So in a way, all our tools can be applied for any style of trading. But yes, different traders, different personality styles, they might prefer one tool above the other. The indicator best for this indicator best for intraday. See, again, what you need to understand is that the indicator does not provide buy sell signals. It only helps you identify where are the demand and supply areas. Once those zones have been identified, you need to qualify them based on your trade plan. If they qualify, they can be your trading opportunities. So again, doesn't matter whether you're doing intraday trading, you're doing swing trading, you're doing investing. It can help in all styles of trading. In intraday, the advantage here is that if you're doing the analysis manually, by the time you're done with your analysis, you might miss the opportunity, right? So the indicator also speeds up the process, which can help you quickly verify that whether the setup is in sync with your trade plan or not. And especially, let's say if you have a paid account on TradingView where you can have a multiple chart layout, you can apply the indicator to these multiple charts, so that at one glance you can see the lower time frame, the refining time frame, the intermediate, the higher. So in just one glance, you'll get to know whether a setup is valid for you or not. So that definitely speeds up the process, which is very, very essential for someone who is into intraday trading, because as an intraday trader, you'll be using very smaller time frames where the speed at which the price is moving is also really, really fast. All right. So not able to get more than 2:1 reward to risk ratio, trailing stop loss gets hit either at 2 or at break even. So again, Pavan, see, it's not that, that you will always get a 2:1 or you'll never get a more than 2:1. So what happens is that once you start planning trades, once you start taking trades, once you have a big enough sample size, try to see what happened with more number of trades that you took. If you find that majority of the trades are going in your favor and eventually they convert into a 3:1 or a 4:1 or a 5:1, that will help you understand maybe I don't want to trail it very aggressively. So what might be happening as of now is you might be trailing it very aggressively where you get a 2:1, or if you don't trail on to it, it starts coming back and maybe your stop loss is getting hit. So you need to have that big enough sample size to understand that what is happening with majority of your trades. And again, even if you're getting a 2:1 most of the times, I won't say it's a bad reward to risk ratio. It's a very good reward to risk ratio. But again, you'll have to see how you are planning your trades. Are you being conservative? Are you being aggressive? If you're being conservative, what happens with majority of my trades? If majority of my trades are eventually giving me better reward to risk ratios, then what I need to do now is maybe I don't want to be very aggressive with my trailing, or maybe what I can do is at 2:1 I can book my partial profits, balance I can trail. So you will have to see based on your personality style, based on the kind of trades you take, based on the frequency of trades you get, what will be the right way to manage those trades so that you can take the maximum advantage out of it. All right, so not able to realize profits. See, when it comes to 2:1, if you're doing a 2:1, like I said, even if you're right only 50% of the times, based on reward to risk ratio, yes, you should have good profits. But the challenge comes, which at times people they don't realize, is because you've only told me you're getting a 2:1. But if you're getting a 2:1 and you're doing intraday trades, then what is going to happen is maybe majority of your profits they go out as brokerage. So that is where the challenge comes. So again, 2:1 is good enough, right? But if that 2:1 is only giving you, let's say, 0.5% because you were only taking a risk of, let's say, 0.25%, and a 2:1 is 0.5%. So what happens is now is maybe a very big portion of it goes out as your brokerage, as an intraday trader. Now let's assume I was doing a same 2:1, but this time I was doing it, let's say, as a MIT trade. So what might happen is that my risk might be around 3%. So when I get a 2:1, I get about 6%, right? And out of that 6%, now my brokerage will be a very small portion. So all these things also they come into play. And again, the next challenge here is if you're doing intraday trading with this very small zone and again a 2:1, when the stop loss will get hit, what will happen is because your zones are narrow, your positions might be bigger positions, and when your stop loss it gets hit, you might get a lot of slippage. So even, let's say, just as an example, if I want to give it a number, let's say if you wanted to take a risk of 1,000 rupees, by the time you get stopped out, maybe you have already lost 1,500. Why? Because of that slippage. So all these challenges are there, which as you start taking more number of trades, you will realize where those challenges are coming from. And based on those challenges, what modifications you need to make to your trade plan, to your trades, that will be the next step for your trade plan. So again, if you start with a trade plan version 1, so once you have taken a number of trades, now you'll have to create your trade plan 1.1, understanding what are the challenges, how do I overcome these challenges, and then you make those modifications to your trade plan. All right, so that brings us to the end of today's session. Thank you everyone for joining in, and yes, wishing you all a very happy Diwali. I'll be seeing you now next weekend. Till then, trade safe, enjoy your Sunday. Take care. Bye-bye.